Welcome back to the program. My name's Kerry Stevenson, and I am really excited today to bring you somebody who I think has done a terrific job in helping everyday Australians understand about investing, but not just investing in property, ladies and gentlemen. This is Shareplicity, a simple approach to share investing by, I'll take my hands out of the way, Danielle Ecuyer. Now, this is a really clean, crisp introduction to investing in shares. But even if you're a seasoned investor, you're just getting started with investing in shares, or you're terrified and don't know what to do, let me tell you, read the book. It is great. So congratulations, Danielle, on a great book. I believe it's doing really well. And I bought a few copies because there's a couple of people that I know who have said to me they're interested in investing in shares. They don't know how to start. Mm-hmm. So let's start with, why did you decide to write a book on investing in shares?
Well, first of all, thank you, Kerry. Thank you for having me. Very kind. I'm very excited. A book on share investing. Well, it seemed a natural fit. I've been involved in share investing since I left university back in the wee dark ages in 1985. And I did it professionally at an institutional level, which is basically dealing with the likes of superannuation funds, hedge funds and the like, for 15 years before I gave it all up gave up my career to have my son, returned because I was living in London, as you know, and returned to Sydney. And after fumbling around in the dark, literally with a few third-party expert fund managers, I decided to take all the funds on board and do it myself. And basically the GFC was the catalyst for that, because I wanted to sell a few months before the GFC, and my fund manager, for quite obvious reasons, didn't see the point of doing that, because they have a mandate to manage your money through whatever cycle. And I decided I wanted to protect my capital. So I've basically been doing it more astutely for the last sort of 12, 13 years. And I've learned so much managing my own money. I learned a lot in the beginning being a research analyst, so analysing the companies, their balance sheets, their profit and loss. I learned more when I moved to emerging market sales in London, which was completely different to looking at the Australian market. But you learn, then again, there's a whole other leap when you actually come to manage your own money, because now you have to manage your own personal risk. And this is very, very different. And I think this is where people don't actually understand the difference. When professional fund managers manage your money, they're kind of being paid to do for it. But when we manage our own money and we see share prices go down, it can be quite scary. Equally, when share prices go up, we all get very excited.
Yeah. Yeah, and I think that's it. There's a psychology to investing, and I think most people have a fear, don't they, about even stepping into investing in shares. What's your view on everyday Australians? Do they understand about the share market, or is it limited to just a few people out there? And was the reason for writing this book to try and share with people that it's not as scary as they think?
Yeah, it's twofold, because I think people either treat it like a casino.
Yeah.
So they get a hot tip. And there's a really good example of this. I was watching a video of a very, very famous US investor called Peter Lynch, who ran the Magellan Fund for Fidelity. And this is going back 1980s, 90s. And he said, what is it with people? They'll get in a cab, and let's just say a cab driver or a friend goes, buy this share, it's going up. And he said they'll go in and they'll put their whole life savings into that. But when they go to buy a car or a refrigerator or a house, they do all this research. So there's kind of like this psychological disconnect. So at one level, people treat it like, I can get rich overnight. And then a lot of them go, it's just all too hard. I'm going to wash my hands of it. I'll just put my money into super and I won't pay any attention.
Yeah.
And both is not good. I get so upset when I hear people being ripped off with financial products. And I actually wrote a first book, an 80,000 word manuscript that's still sitting on the computer, which was largely about this whole concept of how not to get caught in the big traps. And people are too trusting sometimes when it comes to finances. And I think they're too trusting because they get scared and they feel they can't understand it. And that's really why I wanted to write the book, to show pathways for people that you can have a better understanding, that you can become more financially literate. And even if you're not prepared to manage your own money, you can cast a more critical eye over the people that are doing it for you. And I think that's really important, because sometimes we all blindly hand our money to people to manage it for us, and they don't realize what the fund managers are actually doing. I describe in the book, fund managers have mandates when they manage your money. And if their mandate is to outperform an index, you always think, well, I'm going to make money. If the index goes down 10% and they only go down, I don't know, 9.5 or 9%, they've basically achieved their mandate. But for you, you've lost 9% of your capital, and plus you then have to pay them fees. So I think people now are in this great position, and I was actually listening to a really, really good video from CNBC of a major investor actually in Tesla. And he said, we're very lucky at this point in time. There is so much information out there because of the internet, because of people like you, Kerry, doing a great job putting information out into the market, that investors now have almost as much information, retail investors, as professional investors. Now, you and I both know 20 years ago, that wasn't the case. If you had a stockbroker, you probably had quite a lot of money and you would rely upon them and them getting good information. Now, if you're prepared to spend some time, and it does take some time to do some reading and some research, you're almost as on top of the ball as a professional investor, because the companies now are so transparent and there's so much content available on the internet.
Well, I think I agree with you. And it's interesting that when I was reading your book, you were writing this book as COVID started. And
well, yes, sort of. That was actually more the end of the book, but yeah.
Well, you've managed to weave it into the book very, very well, and understanding what's going on. Do you think as a result of where we're sitting now, people are starting to wake up and take a little bit more, pay a bit more attention? Because I know I speak to people about their super funds. They haven't got a clue where it's being invested, and some of them don't even know how much super they have.
Yeah, and that's a real shame, because it's, in spite of all the bad press it gets, it's actually a gift for all of us, because it is a tax-free structure, or a very low tax structure for people to save. And us humans, we can't help ourselves. We basically don't like savings. I mean, you know, if you can go out and have a good time versus popping it away for, you know, the future, we don't like to do it. So I'm a big proponent of saving for the future, and that's what I did furiously when I had when I was making a lot of money in London. I saved furiously into property and shares. But also, sorry, what was the other part of the question? I just got lost. I apologise.
That's all right. We were talking about how you were writing it, you know, with the GFC. And do you think that people, because of the GFC, do you think that they're starting to take more? I guess are they starting to? I guess look at it more closely and start to take more.
Yeah, it's a really interesting point. I think what we've seen, the GFC put a lot of older investors off. They lost a lot of money and they decided to go with property. And we've had a huge property boom, you know, in the last 10, 15 years. And it, of course, has been structurally supported by lower interest rates and high immigration levels. It's interesting, it's the younger generation now that are very, very engaged. They've come into this market as it's fallen, and they've gone, hey, we're never going to be able to afford a house, ever. And why do we want to lock up our money in some bricks and mortar when we mightn't be able to rent it? And I think it's very much, it's the young, it's from anyone who's been saving something from 18 all the way through to 35, that is actually really embraced this market sell-off and have become heavily involved. And again, it goes back to technology. A lot of them now are in a position where they can actually invest overseas. And of course, all the action really, okay, there's been action in the Australian market, but most of it has been happening in the US And obviously China's now being, you know, galloping up the rear, so to speak, in terms of their bull market. So I actually think it's a lot of the youngies getting really engaged and saying it's our turn to try and make some money.
So it's so they're looking at. You mentioned before. You said when you were in London, you invested in property and shares. So you still like property as well as shares, or you say I don't do property, I focus on shares because that's value? Because let's face it, Danielle, at the end of the day, the governments are not going to look after you when you get to a certain ripe old age. And if they do, ladies and gentlemen, it's not going to be enough for a lifestyle that any of us would want. So do you think that people are going to start to, I mean, for example, do you still invest in property, or are you like, no, I'm all in shares?
Well,
And
yeah.
is that a good way for people to protect and grow their wealth? Because the share market can be volatile, as we know from the GFC, and actually just recently in March.
Yeah, absolutely. I always took the position, Kerry, that I wanted a roof over my head, an unencumbered house to live in, unencumbered, no mortgage. So I've always been really, look, I'm not an expert on this, you know. I've always been very pragmatic that you have your house and that's kind of your safe haven. That's always something that if the proverbial hits the fan, you've got an asset that you can divest and you can always downgrade. So I very much split my assets in terms of, you know, my house is broadly half of my wealth, and then I have the other half in a combination of shares, cash, some gold, ETF, which I'm
Oh, lovely. Except she said the wrong word, ladies and gentlemen. She said the wrong word. She said
ETF.
You know what I think about ETFs, don't you? You know I only like physical.
I don't, but I'm sure you'll tell me.
We'll talk about that later. But you know, gold is great as well. And you know what I often say to people: hedge and diversify.
Yeah,
Now,
and that's really the point. Is assets we've had, what people don't realize that post the high inflation of the early 80s, when Paul Volcker, head of the Federal Reserve, squashed inflation out of the system, because we've had very high, as you'd remember, Kerry, the
yeah.
70s were horrendous. They were tough times, very high inflation, very high interest rates at the beginning of the 80s. Now, if you look at interest rates, they have come from 18% down to zero or negative. So that has fueled this massive, massive asset bubble across, well, you can say bubble, but asset prices have become the go-to mechanic to create wealth for people across the world. In Australia, it's been property. In the UK, it's also been property, but it's also shares, and it's also other asset classes. It's prestige cars. It's been, you know, ridiculous things like Hermes bags, handbags, etc. And I think what people don't realize is that assets, financialization of the globe has become so much more important. And I think that's where we're at a cusp at the moment of people saying, well, how do we ever unwind ourselves from this? What happens if interest rates actually go up?
Well, I have a view on that. I don't think we can afford interest rates to go up, which means that people need
Exactly.
to invest in shares because you want to get a return, and you're certainly not going to get a return from putting your money in the bank. And as I always say to you people out there, the governments, they keep putting those magic printing presses on, which means your purchasing power is going less. So you need to invest in something.
Absolutely.
And
Absolutely.
in your book, I think it is chapter 4, deciding which shares to buy. Sometimes when you're just looking at the market and you go, oh my gosh, there's mining shares, there's technology shares, there's biotech. What would you suggest to people who are looking there? Let's take it from two views. I'm just getting started, and I'm a seasoned investor. What shares do we buy at the moment? Is it all just
Yeah.
going to go up, rising tides?
Uh, First of all, your point going to not receiving enough in cash in the bank, that's really, really important. And I, like you, I don't think interest rates are going up anytime soon. I don't think they can afford to put them up, apart from anything else, apart from the fact that I don't think we have any inflationary pressures. So you're right, we have to invest our cash. We cannot just, you know, expect to put it under the bed, our cash, because we're going to suffer. In terms of the market, and it's reflected across the globe. It's very separate. You have old economy value stocks and cyclical stocks, and then you have what is known as the growth stocks, the biotechs on the other side of the coin. Recently, it's been the growth stocks that have been outperforming. The problem at the moment is we've actually got potentially, quote unquote, a depression if we continue to have negative growth, which means cyclical stocks are really, really going to struggle unless we get a vaccine or unless we get that illusory V-shaped recovery.
Danny, let me interrupt. What do you mean by cyclical stocks? Give us some examples.
Okay, cyclicals are banking shares, they're mining shares, they're possibly the residential developers, so property developers. Some people still, I would say, potentially you've got long-term cyclical secular decline in property REITs like mall operators. But of course, once you start to drill into those different sectors, you start to get a few different answers, as you know, Kerry. So for example, the banks are really struggling at the moment because they've got no margin. Like, you know, they're borrowing low, but they can't lend high. So in an environment where interest rates come down, bank margins get squeezed. On top of that, they've got a lot of bad loans coming through. Their property is clearly struggling at the moment, and nobody really knows how this is going to end, because we've got this constant battle between a massive health crisis that we're trying to contain and keeping economic activity rolling over. Other cyclicals like resource shares, well, let's look at the two, you know, the big miners like BHP and Rio and all of those. Well, conversely, they're actually going gangbusters because China, as we know, the elephant in the room, is still buying lots of iron ore. But of course, that's not an easy long-term bet either, because I read the other day China is now heavily investing in creating its own iron ore supply out of Africa. So when you look at cyclical shares, as I describe in the book, there's nothing wrong with cyclicals. But you have to understand, if you're buying, let's say, the bank shares now, you have to have an optimistic view that economic growth is going to trend up over time, for example.
And you don't have that view. So I guess what I'm asking you is, if people have money in the banks, and of course historically the banks have paid good dividends. Let's talk about that. You know, a lot of our sort of older investors, they've been relying on dividends, and dividends are being cut at the moment. So absolutely. Given your background, given that you've written this book, what's your views on the banks at the moment?
I haven't liked the banks for years. I sold all of mine in 2015. Having said that, when Commonwealth Bank gets heavily sold off, I personally just dip my toe in the water, because I know that we're probably going to get a 10, 15, maybe 20% bounce. But if you're looking for what happened in the past to be replicated in the future in terms of your bank dividends, I think people are just dreaming, and I'm not the only voice on that. They're also going to suffer a lot of problems with disruption. Okay, so a lot of the fintechs and everything are going to start to eat away at their models. And this is where it gets a little bit confusing for investors, because they say, well, we've always held banks. Well, now you have to look elsewhere for your dividend income. And there are other stocks, there are other quality stocks. Shareplicity advocates across all the different sectors that you aim for quality, as in quality businesses that have identifiable earning streams, that have strong competitive advantage, that invest for the future, that have the ability to grow their dividends over time with the cash actually in your pocket growing. And a lot of those don't necessarily have such a high dividend yield, but hopefully they're going to keep on growing their dividends. So at the moment, there's a couple of REITs that you can look at, a couple of the petrol station REITs, Waypoint, for example, that used to be the old Viva Energy REIT. That looks okay. I still think Goodman Group is a great example of an excellent model. Industrial property geared towards the e-commerce boom is not going to go away. Data centers, this is a huge growth area.
Yeah, that's a big one.
Big one. So we've got the likes of NextDC, which is still growing. I'm not across Megaport and Macquarie Telecom so much, but they do also have some exposure. But if you look in America, their comparison company, Equinix, is now a reasonably robust dividend payer, because once they had built the data centers and they've expanded to a sufficient stage, they become a property REIT because they're obviously receiving dividend income. Other examples at the moment is probably Amcor, the packaging company, is still having dividends. So you have to look a little bit outside of the box and try and say, I'm going to get my dividend income from maybe some industrials, some selective property REITs. I think Charter Hall's still looking okay. And when I say these companies, I'm not telling your viewers to go out and race and buy them tomorrow.
And by the way, ladies and gentlemen, just to put it out there, this is not financial advice. I am not a financial advisor. These are opinions between Danielle and myself. Please do your own research. I always tell you, hedge and diversify, but do your own research. Be resourceful, get educated, but do your own research. This is a conversation, but Danielle, you have done extremely well. But, you know, the dividend champions, you know, people do want to know. But one of the things you said just before was the US market. And you talked about the US market. I want to talk to you about that a little bit. Tesla, you know, 12 months ago, Tesla was $260. And I think I read yesterday it was like 15 or 1600 US dollars. Is this an insanity play? Is this the casino at work? Or is Tesla still on a tear? Do you like that? Tesla on a tear.
Yeah, I do like that. I wrote in my book, I'm a huge Tesla fan. I've owned it. I've been in and out. I'm currently holding shares. I think what people don't understand, I just listened to a great video. I mentioned the guy before talking about Tesla. He's an investor. And what people don't understand is that Elon Musk single-handedly has decided that he is going to change the world. And that is through disruption, decarbonisation, and breaking down oligopolies. And he has started with the electric vehicles, and anyone that has a Tesla will tell you, you know, you can't go past the Tesla. And every other car manufacturer in the world is playing catch up to the Tesla. He is also, but the growth engine now, it's actually what he's going into is energy production. So his is a transport and an energy company. It's not a car manufacturer. It's kind of like the car was the thing that started, but he's hooking on all these other different aspects to the business. So the energy production is photovoltaics, solar energy. It's his battery systems that were derived out of the Tesla and producing excellent batteries. And now he wants to create mini grids where you can become your own independent energy producer and supplier that you then supply back into the energy systems. And
very clever.
Yeah, and it's transformative. And what people don't realize, he's basically a guy. I haven't read his biography, but you know, I gave it to my son who just gobbled it up. And he's amazing. He goes like with SpaceX. So that's his private space vehicle, which now works very closely with NASA and basically has knocked Boeing for 6. And he says to his engineers, right, you tell me that costs $25,000 to do. I want you to do it for $500. And they look at him and go, that's not possible. He said, well, go away and make it possible. And he keeps knocking them back until he gets the price down. And that's what he's been doing in the electric car, you know, industry. He is going to do it in the energy industry, and he's also now combining other parts to the business. So Tesla is not only a transportation and an energy company, it's a data collection company. So to give you an example,
wow,
Peter Fitzsimons is driving his Tesla down in Kangaroo Valley, and damn, he got a flat tire. So he contacts Tesla and he goes, oh, I'm in Kangaroo Valley. And they tell him from California. We go, we know where you are, okay? Because these cars are computers that are synced into Tesla. You have downloadable software into your Tesla from California.
I don't know whether that's a good idea or a bad idea. Do I really want them to know where I am?
It's no different to your iPhone. It's no different to your laptop. Tesla is the next Microsoft, the next Apple, the next Amazon, but in a different space. So it's a data company. It's going to be a software company. He's going to,
But that share price, Danny, that share price is...
Oh, yeah. It's crazy. It's absolutely crazy. But the point is that the youngies are grabbing hold of it because they go, this is our future. I'm not, I wouldn't buy Tesla at this share price either. Absolutely not. I'm still deliberating whether I take profits and, you know, come back later. But the point is, it's a transformative company, and a lot of people don't understand it because they compare it to, you know, the traditional old models of car manufacturers. And let's face it, the only person that sold cars in the last 12 months is Tesla. Everybody else is fighting for survival and going backwards. The thing about companies like this, I always say it's about risk and managing your risk. If you want to dabble in them, don't put your whole life savings in there. I don't.
So Danny, what would you suggest to people who are just getting started? You know, historically people go, well, just put some money in the banks, it'll give you a good dividend. But you're saying the world is changing. It's all about data. It's all about new technology, and that we should be looking in that direction and sort of infrastructure and data centers rather than looking at the traditional, the banking sector and possibly the some other sectors. What's your advice to people?
Well, it's pretty easy. So if you have money to invest, you have to diversify the risk across a number of different shares. If you stick to the quality theme, there's nothing wrong with buying, let's say, a quality bank or a quality telco and a quality property REIT, but you may want to add a quality healthcare company. I'm really bullish in terms of what you call telehealth or med tech, you know, which is the technology space of healthcare companies. Again, the pandemic has accelerated a lot of these trends. So you don't have to do an either or. You can actually have a mix, because at the end of the day, you usually find 20% of the shares give you 80% of your performance.
Why do you think people are still reticent, those that don't have a share portfolio? Why do you think that they're still reticent? That's the first question. And the second one is, given where we are in terms of unemployment, in terms of the pandemic, do you think that we are potentially in for another share market? I mean, we saw a bit of about 30% decline in March. We're now back on a tear. I look at it, it almost feels like a casino at the moment. Do you think we're going to have another pullback, or do you think this is now a good time for first-time investors and others to get involved in shares? Are we still, asset prices still going to be going up?
I don't think you're going to get asset prices unilaterally going up, but like anything, if you make a decision to invest in the share market, you can never pick the bottom. Okay, some people got really lucky in March. So I think always a good approach is it's called dollar cost averaging. So you say, I want to put $500 a month if you can into the share market, and you can either do that through, and don't hit me, an ETF. Because you can capture the index. You can capture the index. I actually think ETFs have a really good place in the market. I really do. But it's like anything, you have to go to a quality ETF. You have to understand what you're buying.
And for those people out there, an ETF just stands for an exchange traded fund. So it is a fund without a fund manager. Would you say it that way, Danny?
No, they still have fund managers.
Okay.
Yeah, but they track an underlying index, so the ASX 200 or the S&P 500, or they track sectors, or
like gold.
Like gold, exactly. There's a whole different sort. So, you know, personally, I wouldn't go and play around in some of the, you know, you want an exchange traded fund that is large and has lots of liquidity and doesn't concentrate the stocks too much, in my humble opinion. Because if you go and buy a FANG one in the US at this point in time in the market, you could quite easily see that pull back by 10 or 15%, and you might get a little bit upset. So, you know, it's all about, if you get started, as I describe in the book, you can be an investor that is low, medium, or high maintenance, you know, and I'm a high maintenance investor because I really love it. As my fiance says, I'm a nerd. I love reading about this stuff, but not everybody's going to be like me. Not everybody has the time to do this.
Exactly.
So for you, you're taking the view that share markets will go up over time. So the statistic that I've sourced from Market Index is that the Australian share market has returned since 1900 a compound rate of 11.8% per annum, including, big caveat, including income. So when investors look at investing in the Australian share market, you have to look at what we call the total return, which is the income from your dividends plus the capital gain, the capital appreciation of the shares.
Yeah.
Now I do not think that number is achievable going forward in a low interest rate world, a low growth world. But if we could still eke out 5 to 6% a year on average, then you're almost going to double your money every 10 years.
It's a good way of looking at it. So Danielle, let's finish up with a couple of wrap ups for our people listening to this. First of all, I told you at the beginning, ladies and gentlemen, go buy the book. I've read it twice. There it is again, just so you know. Shareplicity by Danielle Ecuyer, and it is a really clean, crisp introduction to shares, and I think you should all read it. And Danielle, what would you say to people listening to us today? Don't treat it as a casino is what I would say. What would you say?
Exactly the same thing. You have to manage your risk. And it's always about, everybody goes, oh, well, did you buy Afterpay? And I said, well, I've been in Afterpay, I've been out of Afterpay, but, even if I was in it, I wouldn't put everything in it. And that's the point, is everybody loves to tell. I always say, when people say, I've made so much money in the share market, I earn this, 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 and this. And then you ask them, you say, well, how many losers have you got sitting in your bottom drawer? And that's the point. People are very keen to tell you how great they are, but they're never honest about all the disasters. So from my perspective, being a woman, being conservative, it's about maintaining your capital as well. So I think be invested, but don't try and shoot the lights out tomorrow. You've got to be patient. Drip the money in, buy an index fund. If you're not happy to go down the area of stock picking, when you get some more confidence, then you can start to add some shares.
That's very good advice, and I love that analogy. It's like the hare and the tortoise. Don't be like the hare, be like the tortoise, slow and steady as she goes, and then come the end, when you're retired, you're going to have a nice little nest egg and not have to rely on the government, because as I always say to people, governments are broke. They are printing more money as we speak. You need to get out there, you need to protect and grow your wealth in these very volatile times. Now, Danielle, I understand that you are also offering to give a couple of our listeners a book or two. Is that correct?
Absolutely. I'm happy for, I don't know, what did we say, the first 2 people to contact you?
The first 2 people that they've got to, clearly, because we're not talking about it till the end, so they've got to have listened till the end. And if they comment below, the first 2 comments, positive comments. If I get a really nasty negative comment, then I'm not sure I'm going to send you a book. And that's the first caveat, the first 2 comments.
Oh, sorry.
That's all right. And the second comment would be, you must live in Australia, because we don't trust the book getting to you if you're overseas. So got to be in Australia, got to make a comment, and they will be signed by yourself.
Absolutely. Absolutely, Mary.
So, signed copy of Shareplicity. It is a great read. If you don't get a copy, go and do yourself a favor, ladies and gentlemen. Just go and buy it, read it, and as I say, be resourceful, get educated, rare Shareplicity. Danielle Ecuyer, thanks for joining me today.
Thank you so much, Kerry. It's been lovely to chat, and thank you for your time.